Welcome back to a brand new season of The Art of SBA Lending. Last season was, wait for it, our biggest season ever. We interviewed the top brass in SBA lending. So where do we go from here? You're going to be seeing more curated content featuring fresh faces from all over SBA lending and folks who are in the ecosystem of SBA lending. We're kicking things off with a bang. We have a two-part panel on the state of small business, featuring Nick Roach, President and CEO of Stone Bank, Bob Woodard, Chief Credit Officer at T-Bank, and Jordan Hallam, Director of Government Guaranteed Lending at SouthState Bank, all of whom have active SBA divisions and insights into their own portfolios, which consist of small businesses. I asked them the questions we're all wondering. Are you seeing an uptick in defaults? Are you seeing a stampede of deferment requests? How do you go about handling a deferment request? We really get into the weeds on this. So stick around. You don't want to miss part one of the State of Small Business panel. The SBA landscape is changing right before our eyes, and technology is a big driver of that. To think, just a decade ago, I was getting physical loan packages mailed to the office. We've come a long way. But a lot of folks are still getting tripped up on emailing documents back and forth. Files are too big, there's security concerns, and my personal favorite, I already sent you that. Now, I don't have those issues because I use Able. Able is a deal acceleration platform focused on driving efficiency and improving the borrower experience. They plug right into your existing LOS and solves the document chaos between your team and your borrowers. Borrowers get a place where they can collaborate on loan documents at any time, and your team can easily name, organize, and push documents with the click of a button. Welcome to the future. I encourage you to go to able.ai for more information and schedule your demo today. Welcome, and thank you for tuning into the Art of SBA Lending. Here we have our State of Small Business panel featuring three esteemed banking and SBA executives. This is going to be a two-part episode, and so you're going to see the first half of it this episode. And I just want to start by making sure everyone gets properly introduced. So Jordan, why don't you go first since you're first on the screen and introduce yourself and give everyone a little bit of background.
Thanks, Ray. Jordan Hallam. I'm down in Sarasota, Florida. I'm the Director of SBA Lending for SouthState Bank, headquartered in Winter Haven, Florida.
All right, Bill, you're next up.
I'm Bill Woodard. I'm the Chief Credit Officer for T-Bank based in Dallas, Texas.
And Nick, by the way, congratulations, Nick. As I've known you, you've been the president of Stone Bank, who has a great SBA division. I just saw this week you were put in the CEO position. So congratulations on that.
Yeah, thanks, Ray. Nick Roach, located in Little Rock, Arkansas with Stone Bank, president and CEO.
We did an awesome episode with Nick early on in the SBA history. If you go to the archives, I think the title was From Bank Teller to President of the Bank, which is an amazing story. And I commented on LinkedIn the other day that we're going to have to revise the title now that you're the CEO. So congrats.
Thanks.
So we're gonna get into the state of small business. We all have SBA departments. We have portfolios, and we're originating new SBA loans. And 2023 was a heck of a ride. So, now that we're starting in 2024, I don't want to jump into it until we reflect a little bit on the previous, few years. So there was a question I wanted to start out with, which is a fill in the blank. And I'm going to go to all of you guys, which is basically fill in the blank. The state of small business is blank. So use one word to kind of answer that question. So Jordan, I'll go to you first. The state of small business is
resilient.
All right. Can you expand on that?
We were all expecting, certainly the economists and the experts were prognosticating that we'd see some sort of recession or downturn in 23. And instead, job reports came out yesterday, better than expected again for I don't know how many months this year. And so I think both the consumer and the commercial business this year proved that they were a lot more resilient than most people expected.
Okay. Nick, what about you? The state of small business is what?
Complicated.
Go ahead.
you've got rate pressure, you've got hiring pressure. I love Jordan's answer. You've just got so many factors playing in that obviously a lot of small borrowers are still fatigued from COVID. They've still got issues left over from that. And, to have a rate hike and issue like we've dealt with in the last 12 months, it's just a complicated time to maneuver as a small business.
Bill, what about you? The state of small business is
I'm going to say optimistic. We're still seeing a lot of small businesses come to us for financing. We're seeing a lot of businesses that want to grow. We're seeing a lot of people that want to buy businesses for a variety of different reasons. I agree with Jordan and Nick. It's been complicated for certain the last year. There are a lot of pressures out there, but overall, the businesses that we're dealing with are, they're optimistic right now. Certainly, there's challenges ahead of them in some cases, but I'd say overall they're optimistic.
right. Well, those are all great answers. And so let's get on with it. So, I just want to start kind of with a general open-ended question. Like, we all have some insights into our own portfolios, and we talk to small business owners, and how are they doing? How are the small business borrowers that you guys have talked to, or that you've heard about? How are they doing?
You know what? I'll jump out there first, and I'd say from what we're seeing, we're surprised at how well some of them are doing. As we're doing our annual reviews, we're seeing a lot of positivity with a lot of our borrowers that we thought would be struggling more than what they are. Seen a lot of good ratios out there. We obviously have some challenges. Everybody does. But they seem to be one-offs versus anything that I could say would be systematic or systemic at this point.
I'll piggyback on what Bill said, which is I think our bank and probably a lot of banks were bracing for impact this year and expecting, an avalanche of defaults and past dues. And don't get me wrong, we've certainly seen an increase with the rising rates on the SBA portfolio. It's put pressure on the portfolio, and we've seen increases in past dues and we've seen increases in defaults, but maybe not to the level that we had expected, which I think goes back to my prior comment about the resiliency. It's not been as severe of an impact as we thought. And then on the origination side, we're still seeing a lot of businesses that 23 numbers were better than 22, which were better than 21. So there's still a lot of upward trending businesses, maybe not across the board. And, there are some differences. Our bank, our footprint is 6 states, but on the SBA side, we lend beyond just those 6 states. So there are some differences depending on the different markets, of course. But overall, I think, it was a better year in terms of financials for the businesses and in terms of performance for the portfolio than we had probably anticipated.
Yeah, because I would think that as we were making loans in 2020 and 2021 with rates, 4 to 6%, and stress testing at maybe 200, maybe 300 basis points, and then all of a sudden 525 basis points later, coupled with supply chain, coupled with inflation, coupled with all of the relief money drying up, that this would be a crap hit in the fan moment. Maybe not as bad as 08, but from what I'm hearing, it sounds like it's doesn't sound as bad as you would think, like you said, Jordan. Nick, what is your take?
Yeah, I would have to agree. I remember at the end of 22, beginning of 23, we're all hearing nothing but you're going to have all these servicing requests. You're going to have all these servicing issues coming up. So get ready, and it just really hasn't panned out that way. One thing as both gentlemen have said, our small businesses are just so resilient and quick to adapt, quick to change. And I think COVID helped a lot with that mentality as well. I saw some really interesting things from some borrowers during that time when, they had to figure a way out, and they did. And I think it made them a better borrower and a better business owner during that time. So,
well, that's good. But are we seeing that we're having to, like, are borrowers coming to us more for concessions or deferments? Because something I've been thinking about ever since COVID, when almost like the expectations changed a little bit, right? The landlords had to give deferments and concessions. The government had to give you money into your business, and you didn't have to pay back a lot of this stuff. So when things get a little tough, are we seeing small business owners come to us earlier and say, hey, cash flow's a little tight. I need a little help here?
I haven't really seen that much. You always have your, few borrowers that are going to try, whether they need it or not, but we really haven't seen, that much. A few deferments here and there, get them over a rough spot. They've got this receivable that didn't pay, or, situational issues. But, early on, I think when the rate hikes, we saw some deferment requests just due to the shock in payment. But it seems like now the revenue streams and profit streams have caught up with, those rate hikes as well.
Yeah, I'd echo that. A lot of what I've seen has been specific to individuals or businesses' circumstances. Same thing with Nick. We had a couple people come to us just asking because they could ask, and when you go through the analysis, sometimes you just make the determination that there's no need for a deferment. Other times, given the situation, there may be, but they've all been very individual for the requests that we've gotten. And of course, I'll temper that with, we've looked at some data about prior interest rate increases and how long it takes to actually affect small business portfolios. So we're being very watchful over the next 12 to 18 months also, because it tends to take about 2 years for interest rate hikes to really kind of settle in and start affecting some industries. I'll still stick with optimistic, but from our side, cautiously optimistic and being mindful of what's coming also, or what could come.
We're not out of the weeds yet.
Yeah.
I unlike Bill and Nick, I would say I think we probably have seen an increase in deferment requests, or as you put it, Ray, concessions. And I think where we're seeing that most frequently are the loans that were originated to either early stage companies or loans that were done right after or right before the COVID outbreak, where those borrowers maybe were signing up for a loan at 3.25%, with a spread, and we were shocking it, thinking 300 basis point shock is more than we'll ever experience. And it was, 525 basis points. And so those borrowers just never had the chance to really build the reserves or have a business get established to the point where it could weather that kind of increase. That seems to be the ones we're probably seeing the most requests from, not the 10-year-old business that got their SBA loan 7 years ago or whatever. Those seem to be okay.
I think there's about to be a big problem for a lot of banks. We're all spread so thin, only once we know of a problem in the portfolio do we put resources on it. We are reactive, not proactive. But I have good news. Our friends at Lumos have a way to score the loans in your portfolio so you can see which loans have a higher chance of having problems, so you can get out in front and help prevent defaults before they occur. Their analysis will provide an overview of your predicted portfolio performance, allowing you to analyze the data on all sorts of levels. You can look at the portfolio as a whole, or by subcategories like industry or geography, or you can go loan by loan and look at the predicted expected loss and probability of default. And you can track these numbers over time so you can start to see trends in your portfolio. Now you have no excuse. You can finally take care of your portfolio the way you should be without having to hire a team of analysts, because Lumos did that for you. Go to lumosdata.com for more information. Well, I want to ask you this follow-up question, guys. Maybe I'll go to Bill on this, but when somebody does come to the bank with a deferment request, how do you handle that, right? Like and I want to keep in mind, we have some newer, lenders in that watch this too. So it's like, this is an educational thing as well, but like, how do you go through the steps of determining, should I give this person a deferment?
Right. Lots of conversations with them. Number one, I think everybody expects that we're going to collect financials. I mean, that's a given. You're going to collect financials and you're going to do some analysis. But what I found is the conversations with the borrowers can be a lot more telling about the situation and what they're dealing with, and understanding what the problems really are. Numbers give you an indicator of the questions to ask. but it's those questions that determine which route you go. And we've had some borrowers, with some very specific circumstances. The hurricane that came through California, when you've got a business that was a construction loan and the business is due to open up and 2 weeks later it gets hit by a hurricane, you end up with some very specific circumstances that you have to deal with in that case. And you really understand that as you're talking to the borrower and you realize what happened and the timing of all of that, and you find ways to work with that. Some borrowers, you can tell in those conversations that they don't really need the deferment or they don't need the interest rate adjustment, and they're just asking because they're asking, right? Those are two completely different situations that you're looking at and you're reviewing. And in some cases, they're just asking because the interest rates went up and they want a lower interest rate. And then we're having conversations about, okay, well, what if rates go down? You're going to be the first one to call me when rates go down. If I fix your rate right now, I want me to lower it again later. So you really have to spend the time with the borrowers to understand the situation and try to figure out what it is that they're looking for and what the underlying reasons are and the drivers of that are, to really make an informed decision and to do something that works for you and the borrower.
Right. Because, the playbook for a small business owner, when you see on the horizon that there's going to be some sort of adverse situation, whether it's just macroeconomics or inflation or whatever, it's the war chest, it's the dry powder, it's where can I get cash flow. And so if one of your biggest monthly outflows is your debt payment, of course they're going to come to us and say, what can we do here? Things are a little tight. Now, I guess my question, Nick, is like, so if they do just want that to basically buy time, essentially, like, is that something you consider as a lender, or do you just go back to them? And if you go and say no, and if you do say no, it's like, what is the coaching there? Like, what do you tell them?
Yeah, I think with, much like Bill said, each borrower is specific, and you've really got to get down to the nitty gritty of what the issue really is. Because I will tell you, sometimes the borrower doesn't really know. They just know that their monthly payment went up, and let's attack that because it's the largest check I have to write, as you said. So sometimes there's, we pick up things in financials, whether they're slow to collect receivables or need to change that practice or whatever it is to actually manage cash, where they could actually be better off. But, back to your specific question, every call is different. If we're in a good collateral position and they have a good reason, we'll probably go along with that deferment depending on how many times they have asked or, what the entire situation metrics are. But when you have to say no, I find it's just best to say no up front and tell them why and tell them what you feel like they can do better or different, or how you may be able to assist them if situation changes.
Yeah, well, this is an interesting part of lending that we don't always talk about and haven't talked about for many years, as defaults have just remained maybe artificially low. I don't know. But, now it's like there is an art, just like there's an art to originating loans, there's an art to servicing them. And, I really want to dive into this, Jordan, because if you, right, the whole point to protect the bank, a deferment, if it could get you from A to B, get you through that isolated incident, like you said, like a hurricane or whatever, then it makes sense to do that, right? Because then we get paid back if you can get past that little rough patch. But then there's also times where a business might come to us and just say, hey, cash flow is down. And then, our next question is like, well, what's your plan, right? So how do you navigate through determining whether a deferment's going to help you at the bank? Because even in those cases where they're just coming to us for relief, it sounds like, we may not want to give it to them, but then what if they start slow paying on the loan or something? So it's like a fine balance, right?
No, and it's a great question. And I was actually going to add this thought as we were on this topic, which is one of the things, and I'm sure everybody on this call does the same thing, but one of the things we really try to focus on when these deferment requests come in is there a, as you put it, isolated event or a short-term issue that's caused this need for deferment? Being in the coastal cities, we deal a lot with hurricanes, and so that's a reason that we've dealt with a lot of deferment requests. but is this something that there's a light at the end of the tunnel? And if we can help them for this 6-month period, they can get back on track and resume normal payments? Or is this something that this business is just, for whatever reason, on a downward trend, and deferring just really kicks the can down the road? It doesn't necessarily do them any good, but delay the inevitable. And that's not good for us. That's not good for the borrower. And so that's one of the things that our servicing team and our credit team who work on these requests together really try to focus on through, not only financial review, but like Bill talked about, lots of conversation with the borrower, trying to really understand where is the business, and is this something that we can point to and say, yes, this is a result of X, or is it just this business is a zombie business, to you, not a particularly kind phrase, but is this a business that's just, we give them a deferment in 7 months, when payments resume, they can't make the payment then either. And now we've just delayed the inevitable. So that's what we really try to focus on.
Makes sense. Okay. Well, I want to get a little bit off this and really go to the flip side, which is, what about those borrowers that are a little more shy to even tell you there's a problem until there's a really big problem? Do you guys ever see that?
Yes.
Sure.
Probably the hardest thing to manage, no matter how many times, we can tell our borrowers, hey, you need to communicate with us, come to us. If you got problems, we're here to help you. Come and talk to us. They're still so hesitant to do so. Not always, but majority of them are, especially when there's problems, or they don't quite recognize the gravity of the situation until it's upon them. And then they feel embarrassed or whatever about the issues.
Exactly, to Nick's point. I think a lot of it is, they've got pride in what they've been doing, and they don't want to admit that they've got a problem, which is understandable. But and when I say yes, I mean literally within the last week or 2 weeks now. Mm-hmm. We've had one that we weren't sure if it was going to survive another week, and we didn't find out about it until then. No matter how much monitoring you do of financials, or making sure taxes and insurance are current, or all of these things that we do throughout the year that we can watch for, you still have times when you just don't know because they're afraid to tell you, and maybe they haven't provided you everything you've asked for, and you can only do so much to gather that information. So those are by far the most challenging, and we've been fortunate in being able to work through most of those. It goes back to having the conversations with the borrowers. And if you do notice something, making sure that they understand that they can come to you if they need something, because I'd rather find out about it sooner rather than wait for it to drop off that cliff.
I know your audience isn't borrowers, but if there are any borrowers listening, over communicate with the bank. Yes. And transparency with the bank are key. That's going to have a better relationship and a better result for everybody.
I've been thinking a lot about this because it goes to the relationship aspect of lending in part because, some of us are more transactional by nature. You have national SBA shops out here getting broker business, and these are transactional. But, it's a relationship because they're stuck with you and you're stuck with them for 10 to 25 years or whenever they pay it off. And then on the flip side, there's just traditional banking, right? Where you're lending to your customers, and that's sort of looked at a little bit differently because you have that relationship. And I had Mike McGinley on the podcast a few weeks ago. He heads up SBA lending for Live Oak, and their servicing strategy was really interesting to me. And I'd like to hear, yours, Jordan, but he was saying that they have like a 90-something% success rate of getting borrowers to actually post-close send their ongoing tax returns. What do you do on the servicing side, if anything, to sort of prevent that lack of communication or to enhance the relationship post-close? Like you said, analysis. Are you getting financials on an annual basis, looking at them, running analysis, that sort of thing?
90%'s amazing. I hope none of the executives from my bank are listening to this because they're going to be having a conversation with me on Monday. But we've got a team of annual servicing managers, and we set the expectation that we're going to request annual financials, but they always seem to forget when the year comes. But we've got a team that reaches out over email over phone call. We've got kind of a format we follow for every borrower, a certain number of outreaches. If we don't get anything, we still fill out an annual servicing memo. We just notate that we weren't able to collect financials, but without being able to put any kind of, there's no teeth in the loan documents that allow us to really do anything. We just ask politely, and sometimes we'll get the relationship manager involved and see if they can reach out as well. That's what we call our BDOs, relationship managers. We'll see if they've still got a relationship, if they can reach out and get it. But I would love to be at 90%, but I'll have to admit we are not. We do not have that success rate with gathering updated financials.
Yeah, I don't think we're at 90% either. We've actually got an automated tickler system that sends emails out to the borrowers when something's due, and then allows them to electronically upload it to us. So that helps quite a bit with getting information in, but we still have, quite a few that will ignore those emails or those requests for financials. That just happens. A lot of what I've got my servicing team doing too, though, is, those same ticklers, we have them out there for taxes and insurance or a variety of other things. And frankly, most of our borrowers are set up on ACH for their payments. So, if we start seeing an insurance go past due, we haven't collected something, they're reaching out immediately, like within days, typically before it comes due, but within days of it becoming past due, to find out what's going on. If we have an ACH bounce back, we're on the phone the next day that happens, trying to communicate with the borrowers and find out what's going on. And those immediate communications when something, trips up with the borrower, and I'm not saying it's a negative, maybe it's just oops, I forgot to transfer money yesterday kind of thing. But those kind of immediate communications help us talk to the borrowers and go, hey, what's going on? And if there is a problem, please call us. And it kind of goes to that relationship base that you were talking about. Those instantaneous communications or near instantaneous helps us establish those relationships so that they know that, hey, one, we're paying attention to what you're supposed to be giving us. And two, if there is a problem, feel free to call us and have that conversation.
If I can add real quick, one thing that I've always found helpful, and it doesn't matter if it's a conventional, because I've done it all, from the conventional side to the SBA side, I always try to find who is their preparer, who is their financial person, make sure I have good contacts for them. And honestly, a lot of times I'll reach out directly to them and or copy the borrower, or even get them to get in a quick three-way call with the borrower and get them to authorize a release back to us. So, the borrowers in my experience are the worst at taking time out of their day, stopping, going to their CPA saying, hey, I need this, hey, I don't. So, worst case, hopefully we can get a contact with the CPA, have them send them to the borrower and just say, hey, will you just forward them to me real fast?
Exactly. And that's where I wanted to go, Nick, because I'm thinking like, first of all, you closed. Now let's say you're buying a business, right? Or you're building something. You're now focused on that thing. And then you get into just running your business, right? And then you have your banker here saying, can you pretty please send me your financials? And you're like, I don't even have my financials up to date. So of course, now, how do you actually change the behavior, right, to get business owners to think a little bit differently? Obviously easier said than done, but like, everyone should have a bookkeeper, right? Have a good CPA. Are we requiring that? And are we offering anything after closing in terms of essentially free analysis, right? Like people pay a lot of money to have, CFOs, outsource CFOs, advisors, consultants, look at financials, see trends, and give that sort of feedback. Like, why aren't we as lenders, and maybe we are, maybe you guys are, but why aren't we offering it as hey, give me your financials so we can give you this free product or service? And then that obviously gets us a higher conversion rate and then mitigates risk in the portfolio, because then we could see problems coming.
That's a great question. We have employed software in the past that would do that for us. It would basically do trends analysis, et cetera, and you could email that to the borrower. I found that most of my borrowers didn't read it or didn't open it, frankly. But usually if it's somebody that you actually have a good relationship with and talk to often, I think the key is just, don't just talk to them once a year when you need financials, but we employ a risk-based servicing model. So at certain levels, they get more contact than others, more review than others, et cetera. So, it may be a quarterly call that we have on all loans over $2 million or whatever it might be, just to, build a relationship. We're also a national footprint SBA lender. So likely we won't see these folks, face to face for years.
Yeah, and that's what most people do, right, Bill? We're reactive, not proactive. We are getting word of an issue, and now we're putting them on a watch list, right? We're treating that issue because we don't. I mean, who has the capacity to do all this stuff?
Yeah, it's a challenge, especially with everything being so virtual and electronic these days. We do nationwide SBA lending, and we talk to our borrowers all over the country, and as much as we can, we bank them. But there's some industries that we deal with that they've got to have that branch across the street from them because they're dealing a lot in cash, right? And I don't have a branch across the street from them, so they're gonna have two banks that they're gonna to work with because maybe that local bank doesn't want to finance the SBA loan for some reason or can't or whatever the issue may be. Maybe we had better pricing and service. I'm going to say that we had better service. But it's a challenge having the staff to be able to make all the contacts, having the borrowers that want to return your phone calls. Some business owners are far more sophisticated than others, and they monitor their financials, and some business owners, they know how to go out and make a sale and collect the cash and pay a bill, but they couldn't tell you an income statement or a balance sheet, and they wouldn't know the difference. So I think there's a lot of things that go into the reasons why it can be challenging at times to establish those relationships and get the borrowers to respond. The more sophisticated they are, I find it easier to work with them because they understand. The less sophisticated they're like, oh, well, you're just my banker and I have to make a loan payment to you, and I really don't want to talk to you because I don't have time today, right? And that's something that, my entire career in banking, we've all struggled with because there's so many variables involved with those conversations.
I'm going to ask you a question, Jordan, on the relationship front, because this is interesting because I feel like I've gotten to a point where I'm super efficient churning deals from my home office on Zoom all day, meeting almost no borrowers. You want to have the relationship. You want to make it so that you're not just a lender, a commodity that you won the deal and now, and you're just basically a commodity essentially, right? You want to be that partnership and have that relationship with the borrower for the long term. But some models just aren't built like that, right? But meeting them in person, it's almost like we're getting away from that. There's a lot of banks that require to meet the borrower in person. And during COVID, it was like, oh, we don't have to do this anymore. We have Zoom. But is it the same? Do you guys care whether you meet the borrowers in person or not?
We don't have any kind of requirement. And even the loans that are out of footprint, we don't require. I know some banks for out of footprint, they still want the lender to fly there and, put eyes on it. We'll hire companies for a site visit. The loans that we get, we're kind of unique in that we're almost exactly 50-50. Half of our business is internally referred in the footprint, and the other half is either broker referred or self-sourced by our lenders. And the ones that are internally referred, the vast majority of those we are meeting in person. And those are definitely much more relationship based. We're usually getting deposits. We don't require it. We don't track deposits for our lenders. I know deposits were a big push for a lot of banks last year, and we never added that as a requirement. It's certainly encouraged. And when they're in footprint, we're telling our lenders, this is a good way for you to give back to your internal partners is to get those deposits. And when there's an opportunity to meet in person, I hope that the team members are doing that. I mean, most of our lenders work remote. Some of them are in a branch or in an LPO or an office somewhere. But even the remote ones, I'm hoping are getting out. And I think they are, certainly on the internally referred. I see the expense reports. I see the travel to visit clients. I know it's happening, but we don't require it. It's not mandated, but it's definitely encouraged.
Bill, do you ever get out there in the field?
Actually, I do. Not often. Only on the Dallas-based deals typically. But if we've got somebody in the area, I'll go out and visit with them. It's our BDOs like to be able to take their chief credit officer out and introduce them to clients, and so it is fun for me to get out as well. Um, as far as the overall, do we meet with clients as much as we possibly can? Our BDOs are meeting with clients. We bank them for deposits as much as we possibly can. Again, there's some situations where we just can't, since we're a community bank and we don't have the footprint that others have. But there's still benefit in that relationship and that face-to-face meeting. So yeah, if we can, we absolutely do.
Nick, having been in banking for a long time, I'm sure you've met in person with many customers. Have you ever, or potential customers, have you ever went to go see someone and just said, I don't think we're going to do this deal?
Oh yeah. Yeah.
Is it just a sense?
Yeah. I mean, there's no substitute for face to face, but I would say I get out less than I used to anymore. But through the SBA process, you're going to have a multitude of conversations with that borrower, and you can kind of get a sense for their character and feel. Part of the sales process and part of the credit process is talking about, I would call it outside of the the deal things, and just kind of get a feel for who they are and where their beliefs are at and things like that, as far as creditworthiness and respect, duty, loyalty, all those things. So you kind of take that as a whole as to who you're dealing with. But oh yeah, I've been on some site visits and said, no way, we're not doing this.
Character might be the most important C of the 5 C's, and getting face to face really helps you learn a lot about that borrower.
Yeah, because you can usually dig out some of those non-deal related discussions and see who they are, and you get to probe and some things you don't get on a 20-minute phone call.
No, that's good. I think a lot of us have gotten more away from the in-person stuff in all across all industries, right? And in fact, I just met with a business broker yesterday, and he essentially, he's a new business broker. He quit his job because they basically told everyone, don't go in the field, during COVID, even after COVID for several years, to the point where he's like, I just have to get out there and meet people, and it's like you said, it's not the same. So I'm interested to see, because as you're trying to get financials from borrowers and trying to get them to pay us back, there's definitely something with, if you have that personal relationship, right? You've been in person with them, you've met them, you're not just a voice in their phone, throughout the loan process. Psychologically, I think that does make a difference.
I think it makes a difference, going back to the servicing conversation. Down the road, they have a comfort level with you, you have a comfort level with them, and it's just all about trust. And I feel like you get a little better, you build that trust a little faster face to face than Zoom.
I would add too, for those BDOs out there or those bankers out there, you go visit a business owner, they want to show you around their business, and you'll learn more getting a tour of that business, even if it's a small office, than you ever could sitting on the phone with somebody. I mean, just an hour out, actually on site, you'll learn more about their operations and what they do than you could ever look at a financial and understand.
Jordan, you nailed it with the character comment. I just always struggle to determine how to assess somebody's character. I mean, obviously you can look at their credit history and you can look at their criminal history, but as you're talking to someone and learning about them, what is it that you're looking out for to try to assess, is this a good character that I can lend to?
Wow, that's tough. I think it's one of those gut things that you just know when you're sitting across a table from somebody. But there's also, there's probing questions that I know I've asked in the past, and I'm sure everybody else asks, where you can kind of lead them and see how transparent are they, how well do they really understand their business. And I'm not saying somebody's a bad character who doesn't understand their business, but I think it all plays into their management ability. And so I think it's, it's hard to say, you're
It is,
talking to
right?
somebody and you get a feel like, is this person being honest with me? I mean, unless they're just a really good actor, I think you can get a good feel. And that's a lot harder to do. Like Nick and Bill were saying, that's a lot harder to do over the phone than it is sitting at somebody's desk. And certainly, if you're touring their office, it's a lot harder for them to hide aspects of the business as well. But I think, to add on to the character thing, to take it more of a positive approach, I can think of a lot of instances of borrowers that on the surface were just they'd be easy to decline. The numbers didn't make sense, whatever else. But when you sat and met with them in person and they just exude passion, and you can just tell, wow, this person understands their business inside and out. They're motivated. They're going to find a way to make this work. I can think of so many instances of those borrowers that we've gotten comfortable where had we not gone and met them in person, I could easily see that being a decline. And they're still borrowers to this day and paying as agreed. And so I think there's just so much to be said for the character piece and understanding who they are as a business owner and as a person.
You know who's a good actor? Sociopaths. So sometimes I will talk to someone who has a criminal history and they'll just explain it. They'll explain why the felony charge wasn't their fault. And I'm a sucker. I'm like, oh yeah, that's
you got a bleeding heart, Ray.
I'm like, yeah. So it's hard because even when you're a BDO, you have to have the discipline to make that assessment in the field, because not everyone behind you is going to have multiple encounters, right, with that borrower. So the BDOs have to make sure they're doing the right thing and looking out for that. And I think it's going to be coming up a lot more, because if times do get tough, character, that's where the rubber meets the road. I want to ask a question. The phrase that comes to mind is throwing good money after bad money. Yes, that's right. So in these cases where we talk about deferments, what if it's not what if deferment's not enough? What if they need more working capital, and you have a loan that it's not in default or anything like that, but they've expressed that, hey, we're having a little bit of cash flow issue and we need some sort of working capital. How do you assess if that is a good loan to make, right? Because again, you don't want to throw good money after bad money. Do you ever see those, Bill?
I think Bill should start with this one as our chief.
Yeah, without trying to be super specific, those are probably some of the more challenging cases. And I would tell anybody out there that's listening, the answer is it depends. Those conversations that you have with the borrower may lead you down the path to go, okay, wait a minute, there's a problem here and I don't need to give them any more money because the chances of me having a problem are pretty high on this. And at that point, you're looking at other sources. Do you have equity available in a home that maybe you can get, some cash that way? Are there assets that you can sell potentially? I've had borrowers that have chosen to sell the real estate and rent because they can restructure their finances that way and they can continue to survive. I've had people sell rental properties and pay us down enough that that gets a payment back to where they can survive. So there's times when you're looking at that and you find out from those conversations, no, I do not need to be any more exposed to this borrower. Let's start talking about what else is available, and maybe I can help direct you in a direction that, helps both of us. Because at that point, you're helping the borrower and helping yourself, right? If they fall off the cliff and just stop paying, well, now everybody loses. Sometimes those conversations, you find out that maybe to Nick's point earlier that, hey, they've got a client that's just slow paying for some reason, or they've grown and they're not managing their receivables as well. There's some of those cases that'll pop up and you go, okay, I can understand this. And, if we can give them this line of credit, then that'll help them through this temporary cash flow problem until they get back on track with these receivables, or maybe they just got a new big contract that they need help funding. There's completely, opposite ends of the spectrum there. And you don't know that until you start having those conversations and really diving into the driving factors behind why they need that cash.
Yeah, because I imagine, yeah, that's a very difficult situation. You really have to understand it and look at it on a case-by-case basis, which makes perfect sense. All right, we're going to pause there. What do you think so far? Leave us a comment on our YouTube channel or over on our LinkedIn page, and come back next week for the second half of the conversation.